How's it going, everyone, and welcome back to part 2 of Leverage Buyout. So let's go over a little bit of what we went over last time. Let's do a quick recap. So we talked a little bit about what an LBO is, and we went through these pictures right here of taking a cash flow, paying down debts, and then ultimately receiving a greater value for that because we pay down the debts and the lenders only have a claim on the debt they provided and then the interest on top of that. Then we talked a little bit about the types of LBOs, we got into who uses them, the key participants in the process, and some notable examples. So today let's get into, we're going to go a little deeper into LBOs, and we're going to start with the characteristics of solid LBO candidates. So what should we look for in a leverage buyout candidate? The first one is a strong cash flow generation. As we saw in the previous, picture, the cash flows over time should go up, and we use those to pay down debt. So it's important that these companies are, producing a strong cash flow. And really the most important aspect of that is that they're steady and they're predictable. Because when we take on debt, we're going to have to repay the debt in a schedule that's going to be very steady over time. They're going to expect that you pay every month. So our cash flows need to be very steady and predictable as well. Another thing is that we want to make sure the company or our target for an LBO doesn't require a whole lot of CapEx or capital expenditures or a whole lot of R&D, research and development, because this will eat into that cash flow. This will take in cash, and instead of paying down the debt, we'll have to build a new facility, or we'll have to buy new equipment, or we'll have to invest in research on a new product. Obviously this is going to depend on the industry and the company, but generally we look for ones where the cash flow can go towards paying down the debt instead of other things. And let's move on to number 2, which is a solid market niche in existing product lines. So this again follows on to the first idea, is that in an industry where we have a niche and we have established customers, it's much more likely that it's going to be much more predictable, very steady. We have these, maybe contracts in place, things like that. And going along with this, we want to look for industries that have low cyclicality. So, things like medical. The economy really isn't going to impact how much people demand medicine or medical care. So things in that realm probably aren't going to cycle as much as a thing like the auto industry, for instance, where, if the economy goes down, people are less likely to go run out and buy a new car. And third one, we want to look for growth opportunities. Again, like we saw, any growth that we are able to get, that is all ours as an LBO buyer, because the lenders only have a claim on that original debt and then whatever interest is on top of that. So any growth that we can achieve is our profit. So that's what we're looking for. And we're really looking for things that are both organic, so just kind of growing our product line, maybe branching out to the same customers, the same industries, things like that. And then we're also looking for opportunities where we can potentially add on another company, go buy another company and put them on top of our platform, is what they're generally referred to as. So the fourth one is a proven management team. I talked a lot about this in the first part of this video series. And really, the management team is going to be the one driving progress within the organization. They're going to be the ones driving growth. They're going to be hitting these targets. So we want to make sure that they are both, experienced, talented, but also committed and motivated. So generally we do this through, getting some skin in the game, giving them some equity, or, having a bonus structure, things like that. We want to make sure the management team is, committed to these growth opportunities. And the fifth one is a viable exit strategy. Obviously, we're not going to hold this investment forever, so we need to have ways to get out of it after the holding period is up. So generally, 2 main buckets that these fall into: selling to other private equity firms, and then also selling to strategic buyers, bigger companies within the space. So now let's get into, how do we drive value in an LBO? And the first one is paying down debt. We've talked about it a lot, really, paying down the original debt so we can get more of the upside. And the second is the interest tax shield, which isn't something we've talked about. But within the tax code, the interest payments we pay back on our debt are tax deductible. So this is another driver of value for an LBO. And the third one, we can increase profitability. Obviously, two ways to do this: increasing revenue or decreasing costs. So this probably is the crux of where private equity firms get a really bad reputation for coming in and trying to cut costs however they can, whether that be laying off people, completely changing processes, things like that. And so what LFM does is we really strive to have as little impact on the business as possible, because we believe, it's, performing well enough that we want to buy it now. So we don't want to come in and, change absolutely everything about it. But this is where, private equity firms have, get a really bad reputation for being the ones that come in and, fire a bunch of people just to cut costs. The fourth one then is transforming non-performing businesses. So kind of the opposite of what I just said, of where a business is doing really well, so we want to leave it alone. Sometimes there are whole businesses or business units or specific processes that are not performing as well as they could be. So we want to come in and we want to transform them so that they're working better. That really drives up the value of the business. So let's get into the pros and cons of high leverage. We've talked a lot about how awesome high leverage is, how we want to get as much of it as possible, but clearly there are also some downsides to it. So let's get into some pros. Obviously, increasing value goes to the equity holders as the debt is paid down. We've talked about that a lot now. The interest tax shield, which I just explained. And then over on the cons, though, we have these very strict financial covenants. When we take out debt, the lender is going to have very specific rules about what we can do with it, when that needs to be paid back, how it needs to be paid back, things like that, which can really limit us. And going into the next point, with increased default risk, if we are unable to meet those, they're still going to expect their money to be paid. So that can come in the form of repossessing our assets, things like that. So we want to make sure, kind of going back to the characteristics we look for, that steady, consistent cash flow, so that we can pay these debts and we don't get into trouble with that. And the last one is refinancing risks. A lot of these covenants will come with stipulations about what kind of debt you can take on, if you can take on debt at all, how these are financed, how these are structured, things like that. They're going to have a lot of rules in place of what you can do when you're using their money. So we've talked about all of this, but how do we actually value or determine if an investment is good, if it's been successful? And we use really one metric. One metric's kind of the standard to go to, and that's called the internal rate of return, or IRR. And this is a kind of a compounded annual rate, growth rate, return rate, whatever you want to call it, a simplified version of that. And it really gives us an idea of just the returns we're getting every year. So let's look at the formula for how we calculate it. An IRR equals terminal equity value, so the value of our equity when we exit, over the value of our equity when we enter. And then that is raised to 1 over n minus 1, where n equals the holding period or the number of years which we hold the business. And so it's a very interesting formula. You can pause the video here and take a look at it. But this is how we calculate that IRR. And so let's go into some maybe some characteristics of what the IRR is telling us. So it's the primary metric used to gauge the attractiveness of an LBO. It measures the total return on equity investment. And 3, a pretty technical definition, is it's the discount rate, which equates to a net present value of 0 for all cash inflows and outflows. 4th, it declines over time. This is really important to keep in mind. If we look at the formula, go back and look at the formula, we saw the number of years up in the exponent, and we see that the more years we hold it, the IRR is going to go down. And this is the idea of that time value of money. The dollar today is worth more than the dollar tomorrow. So all things being equal, we better get a higher rate of return if we're going to hold it for a longer period of time, because that value is going to go down. We'd rather have the dollar today. So 5th, I think I've mentioned this before, but 20 to 25% IRR is the standard threshold for a 3 to 5 year holding period. because anything, kind of below that, when you're starting to think of, if you can go to the stock market and get an IRR of 11%, for instance, once the IRR for private equity starts, going down closer to the 11%, it starts becoming a riskier investment, not worth investing in. So private equity firms generally shoot for that 20 to 25%. And finally, just another method we sometimes use is a cash-on-cash return. So this is basically just a ratio of how much cash we put in to how much cash we get out. And it doesn't take into account how much time we invested. So now let's go into an example. And you can pause it here and write this down and maybe try to do it with the equation yourself. But we have here the terminal value of our equity is going to be $300. The initial value is $100. We're holding it for 5 years. So what is that IRR going to be? Well, like I said, pause it here if you want to do it yourself, but let's go ahead and do it. So the IRR equals 300 over 100 raised to 1 over 5, which is the number of years, minus 1. And we put that in our calculator and we do the math, and we find the IRR is equal to 41.5%, which looks like a pretty attractive LBO candidate when we're shooting for that 20 to 25%. So this was kind of, a high-level overview, a pretty basic example of how we use IRR and how we think about this. But in the next, kind of parts of this series, we'll get in deeper and we'll start to explore a little bit of, more of that debt side of things to, see how attractive these really are. So that'll do it here for part 2, but I will catch you guys in part 3.